Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 332nd VideoCast podcast for the week ending February 26th, 2026. Got a lot of great stuff to cover today, but as always, family first. We had a busy 2 weeks. Went up to Whistler, Canada. The Canadians know how to do skiing, that's for sure. That's Mimi and Annabelle at the top of the mountain in front of the Olympic signs. Points to things to come. There's us getting ready to go snowmobiling. That's me and Mimi on the snowmobile. Couple more. That's me and Annabelle on the gondola. I was very proud of myself. I only skied once in Aspen prior to this. My friend had a house. They invited us out. I went with an instructor, did all the greens and blues. This was like 20 years ago. And then my wife and my friends are like, oh my gosh, you can do all the greens and blues. Just come with us tomorrow. We did Ajax Black. I snowplowed the whole way down. It was traumatic. I spent the rest of the week shooting clays and never skied since. And I was really happy to see no instructors, didn't mess around, got down the greens, had a lot of fun, didn't mess with the blues, but I think I could do the blues and just an incredible time. Caitlin's a super skier, by the way. All right, so that's that. Then we had some pictures there with Caitlin. There's Annabelle hanging out. That's my buddy Daryl and his wife Serena hosted us for such an incredible week. We put it together really, really quickly with some amazing families. Can't thank you enough, Daryl and Serena. What an amazing, amazing, memorable time. That's us tubing, which was super fun at Whistler. There's Annabelle on the mini snowmobile. There's the fam. That's me skiing. That was actually on the bunny hill getting ready. Looking a little nervous there. There's Mimi crushing it. And then a couple more here and we'll get down to it. Then I got home, went to their water polo game. Speaking of which, Mimi and Annabelle had an amazing weekend playing water polo. Fun weekend of water polo games. They both played great and had a ton of goals and assists. We'll just play a couple here. Right here is one. This is Annabelle. Boom. Finds the spot. And then here's Mimi. Here she's coming up the side. Nice pass from her teammate. Walks it in, finds the spot. Boom. Okay, that's me down at the New York. Then I had to come to New York Stock Exchange. I didn't have to, had the privilege to, was super excited. New York Stock Exchange never gets old. Super fun. It was in the middle of the blizzard. There were no cars. They had an emergency, no cars from 9 p.m. till 12 the next day. So I had to take the subway everywhere, which was pretty wild, but kudos to all the staff that made it down. That is behind the scenes at Varney Co. You can see all the prompters and TVs give you an inside view. That's me with my planters, peanuts at our place in New York, which is owned by Hormel, which just beat earnings today. Super excited. That is at the Claman Countdown behind the scenes. That's me with Liz. Liz is one of my favorite people in the world. She gave me my first break on TV 6+ years ago. I'm forever grateful, and it's always amazing to go back and see her in person. This is on the Big Money Show with Taylor Riggs, with Jerry Willis, with Brian Brenberg, and Jackie DeAngelis. Super excited there. Then I had, as I mentioned, the opportunity to join the great Liz Claman. Want to thank Brooke Haliskak and Jake Mack for having me on. We're going to list.
Here to kick off the floor show is Tom Hayes, Great Hill Capital Chairman. This looks like bear hunting at the moment. Down 812 to 813 points for the Dow. The rest are getting hammered.
Yeah.
Buying opportunity. Are you seeing a buy signal here?
Selective buying opportunity. Now we know why Warren Buffett never bought software stocks. He could never get confidence around their moat. And there was a report by a tiny firm out this weekend saying that AI was going to disintermediate all these software companies, the payment companies, et cetera, all the white collar jobs by 2028. So people are scared. People are selling. I think we're set up, Liz. The software group is set up for a violent counter trend rally in coming weeks and months. I would not be a buyer of it. I would be a seller of it.
Why? Why?
Because I think institutions that are trapped right now are going to use the strength to get out over the next few months.
Let's show some of these software names right now. There are two sort of tranches of software. There are the enterprise software names, the Datadogs, the ServiceNow, CRM, Workday, Intuit, etc. And they're getting slammed. They have been for several weeks. And suddenly the cybersecurity guys are getting swept into all of this. And the fear is that the AI platforms like Anthropic's Claude are going to render them obsolete.
Yeah.
I doubt it entirely. They may tamp down a little bit on the subscribership, but what do you think?
Re-rate, and they're not going to have the pricing power. So, as we said last year, not predicting this little report, but we said let's focus on the 493, stay away from the Mag 7 because their CapEx is going up, the AI spend is going up. All those areas that were overcrowded that we warned your viewers about last year have now gotten hit. As a matter of fact, the 493 as a basket has outperformed every single individual Mag 7 stock year to date. You know what's the outperformer this year, which we were pounding the table on, is defensives. Consumer staples had their best start to the year in history. Healthcare is up. That's where we want to stay this year.
Coca-Cola is hitting a record today.
We missed that one, but
That's where Buffett got it.
That's where he got it, right.
He started buying $1 billion worth many years ago. Sure. CRM, Salesforce, reporting earnings today, this week.
Thursday.
There are Thursday, and so is NVIDIA on Wednesday night.
Yeah.
We will, by the way, just so you know, have Jensen Huang on Thursday, the CEO of NVIDIA.
Yes.
That almost seems to be a bellwether of all time for all AI stocks. You got Home Depot tomorrow, along with AMC, GoDaddy, Keurig Dr. Pepper. Then the techies, NVIDIA, Salesforce, Zoom on Wednesday, and you could see Thursday here, Intuit. That'll be interesting because
Salesforce and Intuit are going to be critical for this software massacre, so to speak. NVIDIA is going to be critical for the Mag 7. So if we get some pretty decent numbers and guidance from these two, that could be that violent counter trend rally that we're talking about. But that's for traders. I would be a seller of that over the next few weeks and months.
And I can't let you go without getting at least one name from you that you really are buying selectively and in great amounts.
Okay, listen, the top name today is PayPal. This is the most misunderstood stock in the market right now. It's very much like Alibaba was a year and 2 years ago when you couldn't give the stock away. $6 billion of free cash flow. They're getting takeover attempts now, as rumored today. They're not going to sell the company at this level. They're buying stock at this level. The whole story with PayPal is the ad business that no one's paying attention to. Amazon built the same business. They've got the same guy. It's a 70% margin business. It's going to add $1.5 to $2 billion of free cash flow over the next 3 to 4 years. Everyone's focused on payments. They should be focused on the ad business. They have more data than anyone else.
Okay, but Estee Lauder and Dentsply, ticker symbol X-ray.
My Sirona, Dentsply Sirona. Absolutely love this stock. They're the #1 dental supplier and dental technology company since 1899. They're trading at 7 times earnings. They got slaughtered over the last few years. 5% dividend yield while you wait. We love this turnaround story with the new CEO.
Okay, if we can just show Dentsply, because that's what he was talking about at this moment.
I'll be buying that one today.
Okay, all right, there we go. Well, it's up just a fraction, but year to date, it's up 10.5%. We'll be watching it. Tom, thank you.
Thank you.
For braving the storm to get in.
In here. And we're back. Then I had the privilege to join the great Stu Varney. Want to thank Christian Dagger and Maggie Edwards for having me on. We'll listen in here.
Check futures again, please. I see a little bit of green, but it doesn't make up for all the red that we got yesterday. Thomas Hayes joining me this morning, cover the markets. Okay, tariff turmoil, AI, where's the payoff? All of that brought an avalanche of selling yesterday. When's it going to stop?
Have no fear, relief is near. The good news is this was largely concentrated in the software sector. There was a tiny report out over the weekend that struck a nerve with people, took down a lot of the software stocks. I think what you're going to see in the near term, first off, we've got CRM, Salesforce, and Intuit reporting this week. I think their results will be okay, and I think the sell side's going to come out and defend the software massacre. That's the good news. So we're going to
defend the software massacre. I'm looking at a massacre of Microsoft, for heaven's sake.
That's right. That's part of the software massacre. I think we are going, the market is set up for a violent counter-trend bounce. That's the good news.
Really?
The bad news is that bounce is going to be sold because there's a lot of institutions trapped in software and they want to get out, and these stocks are going to get re-rated. They're losing a little bit of pricing power with all the AI tools. So short-term relief, intermediate term, 2, 3, 4 months down the road, they're going to get resold.
So, I'm just trying to figure this out in terms of Microsoft, because I got a little bit of that stock, okay.
Yeah.
So what you're saying is a violent rebound for a stock like Microsoft
sector,
in the immediate future.
Yeah.
But it won't hold.
It won't hold. It will hold for a few weeks. I think as we get later in the year in the fall, we're going to see further weakness in tech, and that will be your generational buy opportunity to load up on these stocks. But for now, it's gotten oversold. The report that created a lot of this turmoil it's a hypothetical report, and the authors aren't very experienced on Wall Street and don't have a tremendous amount of credibility. So it struck a nerve, but I think you're going to see the credible sources, the sell side, come out and say, wait a second, earnings aren't coming down quite as much as prices. Hold your horses.
Okay, stay with me for the hour.
You got it.
A long time.
Yes. Steve, thanks very much. We'll see you again soon. Thomas, you're still with me. What could the president say tonight that would really help the stock market?
Look, consumer confidence is the name of the game. It's at multi-year lows. I think people are focused on housing affordability, and I think he's got to take policies to bring the 30-year fixed rate mortgage below 6%. That's the line in the sand, and we're very, very close. If he can do that through what Warsh is going to do with lowering rates, with Freddie and Fannie buying $200 billion of mortgage bonds to bring down rates, deregulation, these type of things, and say we're going to make housing affordable, maybe open up some federal lands. This will give people a lot of confidence because there's a younger generation that wants to start their lives with houses, and they're not there. So if you give some confidence on housing, I think you're going to see consumer confidence start to tick up, and that is critical before the election.
All right. Thanks very much, Thomas. Stay there, please. Got more for you later. This is huge. Meta and AMD just announced a big partnership. It's a very big deal. Lauren?
Huge.
Yeah, it's $100 billion, isn't it?
Yeah. So Meta is buying AMD chips in this $100 billion deal. They're playing chess. They have to diversify away from NVIDIA, who is the dominant player. And AMD, as you can see now, up 6%. They are so happy with being number 2. So in this deal, Meta will buy 6 gigawatts of computing power from AMD over several years and give Meta the option to take a 10% stake in the company, controlling the supply chain.
Whoa. What do you make of this?
The crumbs are big. The next one is going to be Intel. You remember we gave that on your show at 19 bucks. It's 45. Wait till you see the crumbs that start to come once they get those fabs humming.
Wait a minute. You mean Intel goes up?
Intel is going to go up further from here. That's going to be the next leg higher when they can start to do deals with these companies. And President Trump is going to promote Intel in getting those deals. So good for AMD, better for Intel down the road.
Okay. I was looking at Home Depot earlier, and it was up because they'd released their earnings. Now it's up 3%. They did well.
Breaking news, it is not an AI stock.
Yeah.
Or at least not yet. Their fourth quarter revenue did miss, but earnings were stronger. The ticket size rose about 2.5% at $91 and change, and professional contractors keep shopping there. So you might be slowing down your do-it-yourself home renovations, but the professional guys are not.
Keurig Dr. Pepper.
Okay, beat and raise. Stock is up 3.5% as a result. They're hoping that their new flavors going forward, like blackberry and creamy coconut, will drive sales.
Does it make that much difference? That kind of flavor stuff?
Yeah, for kids, I think.
Okay, so.
And teens. And if it's trendy on TikTok.
You don't want to comment on this, do you?
I think it should be a private company. I mean, Keurig Dr. Pepper is kind of like a utility. It just keeps throwing off cash. It has a little dividend. It goes nowhere. Just take it private already.
Okay. Right. Hims and hers. Uh-oh. They're down big. Another 10% down. I think I know what the problem is, but you better tell us formally.
They're down 52% this year coming into today. They're down on guidance and regulatory headaches. So they have legal trouble over their copycat drugs with Novo Nordisk, with the FDA, and potentially with the Department of Justice. They're investigating if they should be selling these copycat drugs, which have been pulled from the market. That's a big deal because the GLP-1s are around a third of Hims and Hers total revenue.
This was nothing but a COVID-promoted stock. All they are is a reseller. Stock's down. Stock should be down. No value add there.
Whoa.
Good. Whoa. Tell us how you really feel. Novo Nordisk.
High servers. That's said to be going ahead of schedule, too.
All right, the market's off and running, and Thomas is bringing us his stock picks. The first one is a liquor company, Diageo.
We like defensives this year. We told you last year, get out of the Mag 7. That's what's happened this year. Staples are up. They've had their best start to the year in history, consumer staples. I've got two. They're both down 50%. One is a liquor company, Diageo, yielding over 4% dividend yield. I know you like the dividends.
Diageo is down 50%?
Off of its high, off of its
high?
COVID high. People believe no one's ever going to sip alcohol again because of the Ozempics, et cetera. Trust me, people are sipping alcohol. $2.7 billion of free cash flow. They've taken costs out of the business. They got a new CEO who turned around Tesco. They're cutting costs. This is going to be a great thing. The non-alcoholic business is up 40%. Tequila business up 18%. Guinness up 13%.
Why am I not surprised? Hormel is your other big pick. You always think of Hormel as the spam people.
Spam, they've got Planters peanuts, they've got Skippy peanut butter. This is high protein snacks. It's right in line with GLP-1s. They've got a 4.7% dividend yield. They're also down 50% from their highs. Decade plus low valuation. So this one has raised the dividend every single year for 60 years, Dividend Aristocrat. So lock in your 4.7 and watch it go up.
David Barnson should be listening to this one. All right, thanks so much now. Gavin Newsom, columnist John Lonsky on the show, and he said that this rough winter weather we've been having would be a real drag, could be a drag on the economy. You agree with that?
We're not seeing it. Earnings up 13.4% for Q4. For Q1, we're getting what? We're getting bigger tax refunds than ever. People are going to be spending that money.
Okay. Tom Hayes, thank you very much for being with us and sticking around for the entire
Thanks
hour.
for having me.
All right, check that market, please. Look at the Dow, a 300-point gain. Is this the vigorous rebound bounce that you're talking about?
I think we're due for a counter-trend rally here. We're going to get some strength here in coming weeks, and
okay.
Then you're going to see software resold later in the year.
All right, we'll talk about that later.
Yeah,
You're giving us hope for the moment.
Exactly. And we're back, and that was the scenes cut because I was on for the whole hour as company. Very grateful for that. Then I had the pleasure to join the Big Money Show, also for the full hour. Want to thank Anastasia Cavanis for having me on. We're going to listen in here.
Welcome to the Big Money Show. I'm Brian Brenberg, along with my co-hosts Taylor Riggs, Jerry Willis, Jackie DeAngelis, and with us for the hour, Great Hill Capital Chairman Tom Hayes. Good to see you, sir.
Thanks for having me.
We got a lot of energy around these retirement ideas on this set.
Let's do it.
So, Tom Hayes, I go to you first. What do you think?
I think this was the biggest announcement of the address last night were these retirement accounts. There are 50 million Americans that don't have access to a proper 401k plan. The design of this plan is $1,000 per year matching, provided the person puts in $2,000. So 50 million times 1,000 is 50 billion, which will go into U.S. capital markets. And then the other 2,000 that they're required to put in takes us to over $150 billion a year injected into U.S. capital markets. You couple that with the baby accounts, the Trump accounts. We have just about 3.5 million babies per year at $1,000 a pop. That's going to add another $3 billion. So $153 billion a year going into U.S. equity markets. This is very bullish. This is good for business formation, for capital formation. And I think we're going to start to see the results of this as we move out 6, 12, 18 months down the road.
And I had this issue with the baby bonds that I brought up once before, which is whether it's retirement or baby bonds or whatever it is, if everybody becomes a millionaire, then what does it mean to be a millionaire anymore? Does it mean anything?
Yeah, I think you bring a really important point. There is a flywheel effect called the wealth effect. And if everyone has an ownership stake in capitalism, like Taylor was mentioning, versus a renter's mindset, as their assets go up, and for a lot of these 50 million people, it's going to be the first time they're seeing assets, they're going to feel better, they're going to do better, they're going to make more investments, they're going to spend more money, which is going to drive more earnings, which may enable us to keep the multiple at a reasonable level. But your initial instinct is correct. I think there's a second derivative of the flywheel that we have to keep in mind. And more important than that is just getting more and more people to participate. What I love about this that a lot of people didn't note is that it's a very, we all have IRAs already. We can set up, we can do. All you have to do with this is check something on your tax return, and it automatically starts to happen for you, and you get the compounding effect. Charlie Munger once said the #1 rule is to never interrupt compounding. Compounding is the 8th wonder of the world, as Jerry was pointing out, and that's so critical because it's not just the 2,000, it's 3,000. They have to put up 2 and 1. So after that time period that Jerry referenced, you're looking at 1.5 to 2 million for everyone. That's a very, very positive
and
thing.
just to follow on that for just a second, compounding.
So if everybody has $1 million, by that time, the number that you need to retire, the million will still pale in comparison to what you need.
Yeah, but if you look at the compounded returns of equities over the last 120 years relative to the compounded expectations for inflation over time, you're still going to get ahead of the purchasing power conundrum, whereas if you just had cash or you didn't have these accounts, you're getting left behind by 2 to 3% a year. So as long as you're staying ahead of that on a relative basis, to your point, that $1.5 million is going to be worth less, but it's better than having zero and no purchasing power on top of it. So it gets people ahead of the curve, and I think it's a sensible, reasonable thing to do and get people involved in compounding. The other thing is that $153 billion a year that's going into the market, that's capital markets. What are capital markets for? It's for company creation, job creation, fueling the economy. So it's really good for America First policy and creating those jobs for the future.
Look, if you're putting money into stocks and you're getting productivity out of companies, everyone can be a millionaire. It's only when you're printing the $1 million that it ends up reducing your purchasing power. Taylor, purchasing power, TJX, what's going on?
Let's do it. So we're in the middle of earnings season. This has been a stock that was down and up, and now we're kind of down again. And Tom, want your quick thoughts on this, because look, they beat expectations, but they are flagging lower growth for the year, slowing growth for the year. But look, fourth quarter revenues up about 9% year over year. One thing though, analysts said is this is a company that always guides really conservative. So they're flagging lower growth this year, but most analysts know that that means that the company will beat those expectations. But Tom, I know that you've been all over with consumer confidence, and I'm wondering if this is a little bit of a sign of maybe weakening in consumer confidence.
Yeah, I think this is the calm before the positive storm, because the tax returns are going to be higher than they've been in a long time. The consumer discretionary, restaurant stocks have been left for dead. Retailers, some of the consumer brands, if you think about Nike, if you think about VF Corp, et cetera, a lot of these are going to be turnaround plays when those tax refunds come in. I think people are going to be surprised to the upside. In this quarter, if your stock is down only 1% after earnings, if it was a weaker quarter, it's telling you that's okay, because some companies that have beat are down 10%, and then 2 days later they're positive again. You can't make this up.
So how much of it is the AI part?
Yeah.
How much of it is the other part? Because the other part he can't control as well.
That's right. Well, I live in California, so when he was talking about $1.99 gas and $2 a gallon gas,
Double
I was like, it's more than that. So it's almost $5 a gallon. So. Look, I think as it relates to natural gas, because we have a natural gas play as a backdoor play for the AI trade. We own Comstock Resources, which Jerry Jones owns 71% of the stock. I think natural gas is going to be an enormous part of this future for AI. And his drill baby drill has been very, very successful. Those pro-energy policies are going to enable us to fuel the AI. I do think, following natural gas as closely as I do, a lot of that's been related to weather in this season. So 6%, if you said 16%, I'd say it's, could be related to blue state regulation, and there is a large element to that. But as it relates to the volatility short term, this has been a weather season. You've seen huge spikes in natural gas, and I'd probably attribute it more to that in the short term.
That's fair. It has been really cold here, and we've been seeing weakness in the Mag 7 and the software stocks as well, so I could see why people might be back in. But is there, sort of this resurgence? Have people just kind of said, wow, we panicked on this space, and now it's time to get back in?
Well, we are set up for a violent counter-trend rally to the upside. That's the good news in software and in tech and in AI. The bad news is it's going to be sold in coming months, is my view. A lot of institutions are trapped in these software stocks, and they're going to use the strength to get out and lighten up. The reason is the pricing power is kind of eroded from these AI tools, which is going to cause the multiples to re-rate. So the good news is, it's going to go up for the foreseeable future. The bad news is I think as we get into the back half, we're going to see some new weakness. As it relates to Anthropic, it's not about the $200 million contract. It's about if they don't do what the Department of War says, they're going to lose tens of billions of dollars of valuation when they're raising money in the private markets. You lose the Department of War, you lose all your investors. So Secretary Hegseth has all the leverage here.
If you're in AI, that has to be the message, whether it's Trump messaging or us talking here. And I think Satya Nadella has been out, Microsoft on this, talking about not in your backyard issue, but we'll provide our own power and our own water. They have to do that if they want to win, I think, the heart and the emotion of American people.
I love that.
You know, the first phase of AI, you had a chip bottleneck. Now you're going to have the next phase is going to be a huge energy bottleneck. Give or take, how long does it take to stand up a power plant? You think they're going to wait 3 years until their power plant's ready to go?
Or they can't afford to.
Yeah, exactly.
And of course, Democrats were on board with that for a long time, giving out all these tax breaks.
Yeah.
Now suddenly they're like, oh, that was a mistake. We're not going to do that. They can't figure out how to play it.
Yeah.
All right, let's move on. Coming up.
And in, an earlier block, Tom, when we were sort of joking about retirement plans, those moments just really put it into focus about what this is all about and really praising the heroes of our country and giving them a moment last night.
Yeah. For sure. What about the U.S. gold medal goalie?
Yeah.
What an incredible job he did and the whole team. And I really love the fact that President Trump acknowledged that the women's gold medalist hockey team will be coming to the White House as well. That was a huge win. I was thinking about it this weekend. I said, us beating Canada, both men's and women's, is kind of like Canada beating us in basketball. I mean, this is just unprecedented what happened over the weekend, and it was nice to see them recognized and so many heroes for this country.
Now, I have to say, before we get into this, banks already put together a lot of information about you, and much of it is shared by the government, including, let me tell you, wire transfers, foreign transactions, even some say passports, business and financial data, deposits, withdrawal history, citizenship status, Tom, in some cases.
Yeah.
So, I mean, this seems like a little half step, not like a big leap to me. What do you make of it?
Yeah, it's just going to add more costs. So it's a net negative for the consumer because the banks are going to have more compliance costs to do this. I understand why they want to do it. If you need a passport to shovel snow in New York City, you probably need a passport to open your bank account. I'm kind of torn here. I understand the reason for wanting the extra validation, but I'm not a fan of more compliance costs because that's going to be a drag on earnings, and earnings affects the overall economy. And that if they have the drag on earnings, they can lend less to businesses. If they lend less to businesses, it creates less jobs.
Makes sense.
That said, they can implement it going back retroactively and going to 100 million accounts and saying, please send in your passport. That takes a lot of manpower and it takes a lot of time. So we'll see how it plays out. But I think more than that, it's kind of like saying, you debanked me, and I'm a U.S. citizen, and you're letting all these other people that are not U.S. citizens have accounts. Why don't we have a fair playing field? Is probably how they're thinking about it.
And we're back. Then I had the privilege to join Schwab. This was during the blizzard on Monday morning with Jenny Horn, and I want to thank Diane King Hall, Caitlin Christ, Dan Magru for having me on. We'll listen in here.
Joining me now from the New York Stock Exchange is Thomas J. Hayes, founder and chairman of Great Hill Capital. Thomas, thank you so much for joining us this morning to help us kick off this week. We know we had a lot of news, especially on Friday. It was like 3 news days packed into one, it felt. But as far as these tariff impacts, I mean, how much of an impact do you see this ruling and right now having an effect on these overall markets?
I think it's de minimis, Jenny, and thank you for having me. Basically, he'll have 5 months to get 15%. And 15% is an important number because they already have that with the EU. They already have that with South Korea. They already have that with Japan. So no material change. The key is going to be after 5 months, which is basically a few months before the election. Will the investigations be done that are required with the other section of the code in order to keep all of the tariff revenue coming in? And the answer to that question is usually those investigations take a year. So you could have some uncertainty that you may not have tariffs for a few months before the election. And given the affordability concerns, maybe they won't be in a rush to get those investigations done until early next year. So I think tariffs, short-term volatility, but mostly noise. It's effectively the same. And even Secretary Bessent said the revenue collection this year would be very similar to last year.
Okay, and from an economics perspective, we do know that despite some of the weakness we saw in the job market in 2025, you are looking for around 3 to 4% GDP growth now in 2026. So what really helps us then get there?
Yeah, Secretary Bessent was out talking about those big numbers into the election. I think we're seeing a broadening of Main Street. We saw earnings were very strong. 75% have reported for Q4. 13.2% earnings growth. That's 4% better than expected. Estimates are holding up. 312 for this year on the S&P, $361 next year on the S&P. So there's a lot to like. Obviously, some mixed economic numbers with the manufacturing PMI coming in 1 point less than expected. Inflation number on Friday coming in 1/10 greater than expected. So there are some crosswinds, but I think overall this is going to be the year of Main Street more than it is of Wall Street, because I think we're going to see some volatility as the months pass and we get closer to the election.
Okay, and as far as some stress signals we've gotten from these equities, I mean, like hyperscalers recently have been in a substantial pullback. I mean, like, what do you think stops some of that pressure, and what do you make of some of the recent pullback? Because, I mean, is this healthy, or is this actually signaling some concerns about these hyperscalers?
I think it's concerns about the hyperscalers because you're seeing CapEx as a percentage of operating cash flow up to 60% right now, which is equivalent to big oil, by the way, and now is expected to go up to 92% by the end of 2026, which means free cash flow could turn negative. The market is very concerned about that. Looking at the AI names like software, they are short-term very oversold here. You could see a violent bounce back, but I do think that bounce back is going to be sold as the months pass. So I'd be a little leery of software, even if you get a bounce back in the next 4 to 8 weeks. I think institutions are going to step in and sell that as we move later in the week and try to get out of it until they figure out. Looking at earnings this week, we want to see what Salesforce has to say on Thursday from a software standpoint. We want to see what Intuit has to say. And obviously, we want to see what NVIDIA has to say about Mag 7 CapEx on Wednesday.
Okay, and you did also mention favoring more of these defensive types of stocks this year. I mean, why does a name like Estee Lauder, for example, fit that playbook?
Well, I don't know about you, but for my wife, it's not discretionary. It's a staple. She must have the makeup. $4 billion plus brands, Estee Lauder, Clinique, La Mer. We think that this is a phenomenal business. It absolutely got crushed after COVID. Stock was down from 350 down to 50. We started buying well below 100. It's now back up to 114. We think this is going to go a lot higher. The reason it's going to go higher, they took $1 billion of cost out of the business. They got a new CEO. It's hitting on all cylinders. As far as China, 20% of their sales come from China. China is recovering. Last quarter, China was up 13%. The luxury consumer is back. The U.S. is finally stabilizing. They're back to profitable growth. They've stopped losing share. So we think Estee Lauder has some serious legs moving forward.
I am definitely in that same camp of it. This is unfortunately very much a staple for me, not something that ever feels discretionary. So I can very much resonate with that. But before we let you go, Dentsply is another name that is on your radar as far as a potential name to like this year. So walk us through that narrative.
Yeah, Dentsply Sirona, my Sirona. This has been around since 1899. They are the leader in dental supplies and dental technology, chairside milling, etc. This business also got hammered. It's down from 60, it dropped down to about 10. We started accumulating at $11. It's making its way higher. The new CEO, Dan Scavia, came from Globus Medical, where he had a 4-bagger over his tenure as CFO, CCO, and then CEO. All the heavy lifting is done. They've taken $300 million of costs out of the business. They're going to get cash flow back from $281 million to $400 million. You get a 5.2% dividend yield while you wait. Dentistry is a cyclical business. It's in a COVID hangover, but it's starting to pick back up. We like this story. You get paid while you wait, and it's a free cash flow generator with 125 years of history.
And having actually a pretty decent pre-market day, at least this morning as it stands. So really appreciate you bringing those to our attention and providing all this insight to help us kick off the trading day and this week. Appreciate it, Thomas J. Hayes, founder and chairman of Great Hill Capital.
And we're back. And finally, Ashley Mastronardi, and want to thank Mel Montanas for having me on NYSE Live at the New York Stock Exchange. We'll listen in here.
Joining me now is Tom Hayes. He's the chairman and managing member at Great Hill Capital. Tom, welcome to the New York Stock Exchange.
Thanks for having me, Ashley.
All right, so we heard Friday's news that the Supreme Court struck down Trump's tariffs. How did that impact markets?
I think it's a non-issue. It does bring a level of uncertainty. He's going to do 15% for the next 5 months. That takes us to July. And, you know, the interesting thing about 15%, that's the number they already have with Europe. That's the number they already have with South Korea. That's the number they already have with Japan. Now, the issue is they have to do these investigations to access the other code of the 1974 Tariff Act. Those investigations usually take a year. So at the end of 5 months, you might be at a cliff where tariff revenue actually declines if he doesn't get congressional approval for an extension. So I think that's where the uncertainty comes in, but I think that's also a positive going into the election. I don't know that they're going to be in a big rush to get more tariffs on right before the election. That'll be a January issue.
All right, and what else are you tracking as we approach today's session?
Well, I think a couple of things. First off, earnings have been good, okay? Up 13.2% earnings growth with 75% reporting, so that's positive. Estimates have stayed up, $312 for this year on the S&P, $361 for next year. Economic data was a little mixed on Friday. You saw the manufacturing PMI 1 point less than expected. You saw inflation 0.1% higher than expected. And you saw job creation last year was the lowest outside of a recession since 2003 with 181,000. You take that with a little grain of salt because when your unemployment rate is at 4.3%, it's hard to create a lot of jobs because everyone's already employed. So I think it sets the stage for constructive follow through for the next couple of months. You look at software is dramatically oversold. I would be careful on this one. I think we're going to get a violent counter trend bounce that is going to be sold over the coming months. So if you see this huge rally, people are going to say, oh, software's out of the water, it was overblown. I think it's going to show continued weakness into the end of the year because it's very hard to assess the terminal value on that. And then finally, Mag 7, the CapEx as a percentage of operating cash flow is getting too high. Okay, it's now 60%, which is equivalent to big oil, and it's expected to go now with Amazon taking up their numbers by 200 billion. It's expected to go to 92% of operating cash flow, which will make free cash flow negative. And how do you value that? So are we going to start to see some of these Mag 7 or hyperscalers start to walk back some of their CapEx? We might find out on Wednesday when we hear from NVIDIA and see what those commitments are. And then on Thursday when we hear from Salesforce, what is the software story, and Intuit, what is the software story, because those stocks have been hit hard.
And that leads to my next question. Of course, we're at the back half of earnings season. NVIDIA will report Wednesday after the bell. What are you going to be listening for?
I think CapEx commitments, I think it's less what they say and more the market's reaction to it. I think we have something called like a bit of a debasement trade happening this quarter, meaning even if companies report well, they're getting sold off after their reports. Companies that have been beating on top line, bottom line, and increasing guidance, a lot of those have sold off as well. So I think it's less what Jensen Huang says, because Jensen's always going to say everything's great, and if it's not great, he's going to say we're going to make so much money on robots, it's going to be incredible anyway. Let's see what the market does afterwards, and that's going to tell us what we can expect for the next couple of months in terms of does Mag 7 get a bid?
Do the hyperscalers get a bid? And to a lesser extent, do the AI-affected software companies get a bid? Because those have been the three weights. While defensives have done unbelievably well starting the year, staples have had their best start to the year in history. Healthcare is doing well. A lot of the defensives, even materials and energy, are doing well to start the year. I think that's going to persist, that rotation. 493 doing better than the Mag 7. Small cap doing better than large cap, international doing better than domestic with the weaker dollar.
And you also touched on those inflation numbers that came out. We got PCE data, GDP data on Friday. What is your take on all of that?
I think it was mixed. I think Bessent came out and tried to reassure the market that he's expecting 3 to 4% GDP. I wouldn't put it past him. You've got increased tax refunds coming. You've got deregulation coming. You have a little bit of tariff relief, believe it or not, in the short term. So I think those all bode well for Main Street. I think the market will hold up for the next couple of months. But in a midterm election year, going back 70 years, you tend to get an intra-year drawdown and a lot of volatility and uncertainty into the election. So I think we stay strong into April or so, maybe May, and then expect some volatility, which is why you want to have exposure to defensives like healthcare, staples, and the like.
Speaking of, you were mentioning these other sectors. Any other sectors besides those that are interesting to you right now?
Well, I think energy has been very interesting. Everyone was bearish on energy coming into the year, but if you're going to power all these data centers and all the demand, you want to have exposure there. We've got National Oil, Varco in our portfolio. Natural gas, we've got Comstock Resources. So we definitely like energy. Materials has started to perform. But for us, we want to stick with staples like Estee Lauder and healthcare like Dentsply Sirona, the leading supplier of dental supplies and technologies. They've been around since 1899. That's a turnaround story.
All right. Anything under the radar that you think might become a big headline in the coming weeks or months?
I think the big worry is Mag 7 capex or free cash flow turning negative. You know, buybacks are at a 5-year low, the lowest since 2020. So earnings growth is decelerating for the Mag 7. Capex is increasing. Buybacks are declining. So we really have to keep our eye on the hyperscalers. And the big headline would be, who blinks first? You remember when Mark Zuckerberg was investing in the metaverse and the stock went down a lot, and then all of a sudden he said, we're going to stop investing, and the stock rebounded. The question is, who's going to blink first and say, we're going to ease up on our capex, and then what impact will that have on the market? Does the Mag 7 start to rally if and when that happens, and who's going to be the first one to blink?
All right, Tom Hayes, chairman and managing member at Great Hill Capital. Thank you so much for joining us at the New York Stock Exchange.
Thank you, Ashley. And we're back. Want to thank Shazwat Kahun and Ragini Mathur for having me in their Reuters article this week. Quote of the week from the great Charlie Munger: the wise ones bet heavily when the world offers them opportunity. They bet big when they have the odds, and the rest of the time they don't. It's just that simple. Kind of like when you have these great companies trading at single-digit multiples. If you remember a couple of years ago, generating $25 billion of free cash flow, and more recently, $6 billion of free cash flow. We are taking advantage, pulling out the bucket, not the thimble. Charlie, our job is to find a few intelligent things to do, not keep up with every damn thing in the world. And we couldn't agree more. So also want to thank our amazing supportive audience who have not only been ordering, so we're grateful for that, because it's been like 20-1, the people ordering stuff and telling their friends and family about the podcast because they're getting value. But the 1 out of 20 who are sending in photos, that makes a difference because people want to see the community. And this week we had Adam Cizoni from Hungary send in his picture with his Hedge Fund Tips hat. Super grateful for that. And you can go through and see all these amazing people, part of our community. More and more people joining every week. You know, many of you can't afford to become clients. All we ask, if you're getting value and making a lot of money, and we get all the emails and testimonials all the time, please just share the good news with one person you care about each week. Just share the podcast. If it can help them, that's great. And as we keep growing, we'll keep doing this for you. And we're just having a lot of fun doing it. So now down to data. GXO Logistics from Morgan Stanley, higher gear. They took the price target up to 75. For all those CEOs listening in, when Patrick Kelleher came on the pod, I think he was in the high 40s or low 50s. Now he's on his way back to the promised land, doing an unbelievable job with execution. Last night, I put this out. There was a lot of rumors about Stripe wanting to buy PayPal. And I thought it was comical because Stripe did this phony tender offer to themselves where they bought in a few shares at $159 billion valuation. They have about the same total payment volume as PayPal, give or take $1.8 trillion. Yet PayPal has 3 times the free cash flow, $6 billion a year versus $2 billion a year. Stripe values themselves at $159 billion. PayPal is like $45 billion. And, you know, I've seen boards do stupid shit when they're scared about losing their jobs, AKA sell the company at a low valuation. That was my biggest fear with Cooper Standard. And I told management when I met with them, when we put the position on in May of 2022, you have to play this cycle. Don't do stupid shit like Tenneco did and sold at a 20% premium in the hole and robbed their shareholders of 100 to 200 to 300% upside. In the case of Cooper Standard, 800% upside they would have stolen from us if they had sold in the hole. So we needed to get this out there and make sure Enrique wasn't going to do anything stupid like sell this thing at 7 times earnings when he could basically buy in the entire company. We don't need a buyer. We are the buyer. We can buy in 75% of the float over the next 5 years from our free cash flow. Our ad business alone, as I discussed with Liz, will be worth over $45 billion alone in 3 to 5 years. Where do I get that? We're going to talk about the parallels. Most people don't know Amazon, 50% of Amazon's operating income comes from their ad business, not their retail business, the boxes that come to your house every day, well, AWS is a contributor, not from the video business, not from any of that stuff. It's from the ad business. It's a 70% margin business, and no one has better data than PayPal. So everyone keeps focusing on the rails and payment rails and margin compression and branded checkout, and they're missing the forest for the trees. The guy who is taking over the ad business, who's been there for a year and is getting everything going, it's just being rolled out to small businesses now. He created the ad business for Amazon, and then he did it again and created a $2 billion ad business for Uber, and they don't have 1/1000th of the percent of data that PayPal has. This is going to be a monster, so we didn't want them selling in the hole. And forget the ad business promises pie in the sky. The magic of buybacks, if they just buy in the 75% over the next 3 to 5 years, which they've already started on, so you could actually say they're going to get over 80%, you got a 5-bagger. That's if you get no growth and no multiple expansion. I'm telling you, you're going to get both because consumer confidence is going to come back. Enrique is going to fix this. She's going to cut a bunch of unnecessary staff, and this is going to be a home run. And so it ran up on the rumors that PayPal was going to be bought by Stripe, and that's why I put this out. By the way, we got crazy amount, 41,000 views, 311 likes, 32 retweets. I mean, people, it struck a chord for sure. And then fortunately, the company came out today or leaked through CNBC that they had hired bankers to prevent unwanted takeovers. And that is music to my ears. For a couple of reasons. One, we'll be able to get more shares in the coming days at a lower price. And 2, they're not going to steal the dramatic upside of the next few years from me and from my clients who have bought when it was hard to buy, bought a lot more when it was harder or easier, depending how you look at, and brought our basis down now to 53.05, and we're going to be down in the 52s by the end of this week, I think, if we can get some weakness here, and then let Enrique come in on Monday as his first day of CEO, lay out his plan, do the cuts, start to implement the buybacks, get everything in gear, cut the unnecessary fantasy projects from Alex Chris, and get down to business like he did with HPQ, trough to peak, 3.5 bagger in a few years. We love this. So glad to hear that they are fending off unwarranted takeovers at ridiculous prices, and they have their heads on straight. Cooper Standard refinance all of their debt. They're going to get 120 basis points of net interest expense improvement, which is basically $13 million a year in savings, which is give or take 75 cents a share, put a 20 times multiple. So that's worth, $15 to $18 of value just in that savings alone. So we're very excited they got that done. And by the way, if rates go lower, they can do it again. So, if you expected more, market expected a little more, it's not the end of the world. The key is volumes and incentives keep going up, and this continues to play on. Etsy sold Depop, created a bunch of cash. They're going to focus on the core franchise. We're going to talk about that this week. Software price to earnings ratio versus year-on-year change in S&P software EPS. You can see a huge divergence here, and that's why I said on the Claman Countdown on Monday that we were set up for a violent counter-trend rally, aka software stocks would go up from being smashed. You're seeing that literally the next day, and now follow through today and beyond. So you're going to get a huge bounce. A lot of people are going to get faked out and buy up. Once it bounces 20% off the low. This is going to be resold towards the end of the year. I think a lot of these software stocks are going to be left for dead in the fall, and that's when we'll start sniffing around. Even though we don't do software, some of them are going to get so cheap, we're going to get very, very interested. Software stocks have lagged the market by almost 30% since the start of 2025, and in the last 6 months have given back all of their outperformance since 2020. Key point here, this was the only decade in 120 years that, you could buy a basket of stocks trading at 10 times sales and losing money and outperform the S&P 500. Every other decade, you would have lost 90% of your money within 24 months. This was the exception. A lot of that was related to SaaS. The gig is up. They are going to get re-rated. They're going to lose pricing power, but there will be an equilibrium where they make sense to own. It's just not yet. So as they rally over the next couple of months and everyone gets sucked back in, just remember, if you want to get sucked in, do it in the fall at much lower prices. Trend and cycle roadmap from Slumer. By the way, that stuff was from Strategas. So thank you for that. Here's the NASDAQ, went up against this resistance, now is finding support, and we'll see what happens. NVIDIA, was kind of priced for perfection going in, some concerns about China, etc. We'll see how that plays out. We also talked about CapEx as a percentage of operating income, as a percentage of cash flow, is 60% going to 92%, which means operating cash flow, which means free cash flow could turn negative by the end of this year for the AI hyperscalers if none of them blink like Zuckerberg did in the Meta days when he was investing in the Meta universe. His stock collapsed, and then he said, okay, we're going to cut back on CapEx. I think you're going to see a similar situation this fall. They're going to keep spending, and then finally the market's going to give them no credit for a return on investment. You're going to get a lot of these stocks beat down in the fall. We will be buying them just like we were buying Amazon and Google in the fall of 2022. It's just too early, in my opinion. So we wait and we sit on our hands, and we are in all these names that are unrelated to that in the interim. Here's NASDAQ against the support. I wouldn't be surprised to see a big rally. Semiconductor trying to break out here. Here's software, as you can see, completely round tripped from 2025 all the way back down to the support. Probably holds here for a bounce, maybe up to 98 before rolling back over. We shall see. Dow Jones Real Estate breaking out. TLT is breaking out, which is why mortgage rates are at multi-year lows, getting ready to break that 6% handle we've been talking about as a critical mental threshold. Moving along. Private credit. I've been warning about this for the last year or so. I will say this. Number one, it's a scam, okay? In the sense that everyone wants private credit and private equity because there's no mark to market. You want mark to market so you can see the oncoming bus, okay? If your price is going down, you can say what's wrong, and you can either say the market's wrong or the market's right, let me get out now. With private credit and private equity, the reason it's so popular is because pensions and consultants can keep their jobs allocating billions of dollars and having fancy dinners without any mark to market. So they have zero volatility, their Sharpe ratios improve, and they get no mark to market until they get the marks to zero, which is what you're seeing now at the margins. That's the bad news. The good news is these guys are going to get bailed out for another few years when Warsh comes in and lowers rates again. So there's a lot of shit out there that is going to get pushed forward because rates are going to keep coming down, and we'll deal with this 3 to 5 years out when you have a real Armageddon. This, I think, is a false alarm. You'll see some stuff at the margins, but those of you tempted by the enticement of no mark to markets, you want mark to markets on a daily basis so you can see what the hell is going on. You do not want this fake no marks until it's marked down to zero that you see in private equity, that you see in private credit. The other thing is, like, there's all these stories about how private equity has outperformed over all of these years, et cetera, et cetera, et cetera. Business is business. They don't get a better return on capital because they're bought by a bunch of guys in a boardroom in Greenwich with Laura Pena loafers on, okay? Whether it's public or it's private, it still has to generate return on capital. And just because it's in the private market doesn't mean it generates a higher return on invested capital than if it's in the public markets. It's a mark-to-market scam. There's been a lot of trading of assets between funds so they can continue to collect the 2% management fee in addition to the carry. And they just trade overvalued assets back and forth. And eventually the music stops because one of them gets redemptions. Then there's no one to sell to. There's no real market for it. And you get all the markets at once. So all the pension guys that don't want mark to markets with good managers, enjoy that. When the music's up, you're going to be slaughtered. So next week, I'm going to tell you how I really feel about the asset class. PayPal, Mizuho took the price target up. Opinion follows trend once the buyout or fake buyout offer came. That's that. Wolf, same thing. Talked about the buyout opportunity and the optionality. What no one's talking about is the ad business, which we're going to get to in a second. Mizuho takes it up. Cooper Standard refinances. Advanced Auto Parts got an upgrade. Price target 60 from Morgan Stanley after earnings. We're going to talk about that one today. Online spending growth has surged in 2025. That's good for the Etsy's of the world. Tariff lawsuits skyrocket after Supreme Court arguments. So there's 1,000 people looking for refunds. Okay. Here's what I wanted to show you guys. Amazon's advertising business is a major high-margin driver of the company's profitability, with estimates suggesting it contributes over 50% of the company's total operating income. While the exact EBITDA breakdown for the advertising division is not fully separated in official filings, analysts indicate that ad revenues operate with margins of roughly 70%, making them significantly more profitable than Amazon's core retail business, and on a margin basis, potentially more profitable than Amazon Web Services. Massive contribution, crown jewel, high operating margins, rapid growth in revenue, grew 22% in Q4 alone, high intent revenue, people that are going to buy, etc. So by 2025, advertising had evolved from a small, quote, other revenue category into a critical pillar of Amazon's financial health, with analysts highlighting that it effectively funds the thinner margins of the retail shipping and logistics business. Ladies and gentlemen, everyone's focused about the thin margin payments business and the take rates and all that stuff. And what they're not paying attention to is PayPal has one of the most robust data sets of 430 million active users, 30 million merchants, and they're going to turn this into a ad cash machine with the same guy, Mark Rether, that did it at Uber and did it at Amazon. So here we go. Here's the other thing that I want to show you guys. Everyone's wondering about AI, what's going to happen to active management, etc. The average holding period of a stock on the New York Stock Exchange has gone from 7 years in the 50s and 60s down to less than a year currently. And what is going to happen is those people that are trading on a short-term basis, i.e. 0 to 18 months, are going to be arbed out. The machines are going to beat you all day from Sunday. And even now they're arbed out. They just don't know it. They think that they see some chart pattern that, a million other people aren't looking at. And what's, as a result of that, the dislocations are going to last longer. So those who have a longer term time horizon, like we do, of 3 to 5 years, are going to have more and more and more opportunities, because the computers and the AI are going to crowd into what's hot all at once. And then when they get out, they're going to get out all at once. So the volatility is going to be more violent when everyone exits. The trends are going to be a little longer, and the out of favors are going to last a bit longer, enabling us to build positions over a longer period. So if anything, our opportunities are going to dramatically go up in the next 5 to 10 years because of this, which I'm so excited. Here's Tom Brady sporting the Canada Goose with his children. He now seems like a paid spokesperson for Canada Goose, which we love. Record revenues, record free cash flow. His kids got the Canada Goose on. They're skiing. I don't know where they were. Switzerland. Okay, that's pretty cool. On Instagram, getting tons of likes and retweets. He's got tons of these pictures, 3 or 4 of them. S&P equal weight outperforming. We had talked about that all last week. Alibaba riding the China AI wave. Alibaba's outperforming its largest rivals thanks to its AI efforts. U.S. historically saw historically weak jobs growth in 2025. It was the lowest jobs growth outside of a recession since 2003. I think this is probably a better, closer comparison to 2003 as tech starts to come off. But it's also hard to create a lot of jobs when you have an unemployment rate of 4.3%. So the headline is a little bit skewed. CIOs telling us CEOs to slow CapEx. This will be who blinks first in coming months. My guess is most of them won't blink until the fall when their stocks are down a lot more, and we will be buying ahead of that. Earnings season, next 12 months, S&P revisions are top decile. It's funny. Someone said to me that was coming in mid-quarter at the 5 million, should I wait until weakness? I said, yeah, you can wait until, more weakness, but you're never going to have an opportunity to buy PayPal at $40 again. So you tell me, AKA there's always something to do. When the market's super high, defensives are on sale. When the market's super low, defensives are super expensive, and we're selling out of those and we're buying in tech. So we can't buy tech now. We'd be buying tech later. You can't buy PayPal later at 40 because it'll be at 70 or 80. So we're buying PayPal now at 40 and 45. So the answer is market time is a fool's errand. We look at things on a company by company basis, and that's why we run in separately managed accounts, is so we can put new clients in those stocks we believe are just leaving the station, not already cruising at 30,000 feet. As a matter of fact, this is the first time in forever that I've actually looked at Baba as a position for brand new clients. It's hard to do that when you have a much lower basis, but it's getting interesting again. So earnings season, next 12-month S&P revisions are top decile for the third consecutive quarter. Earnings have been good. Biggest equities versus bonds relative overweight since February of 2020. 2022. We love long bonds here. We love 3-handle 10-year yields coming to a theater near you, which is going to help real estate. Boom expectations are the highest since February 2022. So there's a little euphoria. I think this lasts another month and a half or so. We will be harvesting a couple of positions we have in mind into that strength and go into any volatility with some cash on the balance sheet, which we're excited about. And investor sentiment, the highest since June of 2021. If you remember, the market didn't cap out till early 2022, so this can run a bit longer, and we think it shall. Dollar is still overvalued according to this chart. We agree it's going to persist in a downtrend over the next couple of years with some counter trend bounces along the way. S&P 493 has outperformed every Magnificent 7 stock to start 2026. You guys knew that was coming. Tomorrow's newspaper today at Hedge Fund Tips with Tom Hayes. Here we are. 80% of earnings done, 5% better than expected, 12-13% year-on-year growth. ISM manufacturing is starting to inflect. That helps the 493. Came in a point lighter than expected, but still above 50, which is expansion, which is key. Companies with significant foreign exposure had higher beat rates in Q4. We have a number of companies that have a lot of foreign sales, which is by design, whether it's Dentsply Sirona, and some of the others. Manufacturing capacity is picking up after 10 years of underinvestment. We like that. Here's the distribution of S&P 500 annual returns. So you can see those years that you have. So the mean seems to be mid-teens. I think we're going to be probably in here, the 0 to 10% range, mid-single digits for the indices, lots of money for under the surface. Institutional clients were the biggest net sellers net last week. This chart was super important. I want to kind of go through this as it relates to PayPal, because I showed you in the tweet, one, we can buy back 75% of shares. Two, that implies a 5-bagger if there's no earnings growth and if there's no multiple expansion. That'll take 5 years. We probably won't be in it for the full 5 years. But anyway, the upside is much greater. Henry Singleton was one of the greatest CEOs of all time. He ran Teledyne in the 70s, and he actually bought in 90% of the share count and had a 53-bagger over those 10 years. So when the stock was super highly valued, he used the stock to make acquisitions. When it was super low valued, he would buy in the stock or tender for the stock at that time. An investor who bought Teledyne stock in 1966 was rewarded with an annual return of 17.9% over 25 years, or a return of 53 times his invested capital. That compares to 6.7 times for the S&P, 9 times for General Electric, and 7.1 times for comparable conglomerates. And you can be sure that PayPal knows about this playbook and is aware of the buyback effect. Outflows were led by large caps in the last few weeks. Year-on-year growth in S&P 500 cash use. Most of it has been going to CapEx. That is going to backfire, and we will be the beneficiaries of that in Q3 and Q4. If the Mag 7 basket declines by 15%, the 493 would have to be up 8% to keep the S&P 500 flat. If the Mag 7 declines by 20%, the 493 would have to be up 10.8 to keep the S&P flat. I could see a scenario where Mag 7 is down 10%, the rest of the market's up 5.4, and the indices are flat. That makes a lot of sense. Defensives versus cyclicals just starting to break out. Defensives meaning utility, staples, healthcare. We love the healthcare and the staples versus discretionary and technology. I'm not sure why they're calling technology cyclical, but anyway, this is the wrong header for the right data. The rest of the market outperforming relative to tech. S&P 500 index during midterm years based on Fed cycles. So if you are in an easing cycle, which we are now, you get strength into May and then a lot of weakness into August, September, October before the election. After the election resolves, you get a rally. If you are in a tightening cycle, which we are not, the weakness starts a lot earlier. And if you're in all midterm years, easing or tightening or neutral, you get the same strength into late April, early May, weakness into the election, and then resolves higher. That's the near-term playbook. A lot of inflows coming in. That's going to get washed out third quarter. Average annualized S&P index total return for all months when U.S. confidence rises versus when U.S. confidence declines. That's from Paulson, 1960 to 26. When that rises, you're at 19.2%. When it declines at 4.9. This is something that I've had my sights on aggressively because you can also overlay it with the PayPal chart. Consumer confidence is at the lowest level since COVID. And then prior to that, the great financial crisis is even lower than that. So it's now testing the bottom it put in a year ago. You'll see every time that it bottoms, it does the same thing. As that starts to rip higher, PayPal is going to be a huge beneficiary and others. So we'll keep an eye on that. I do think even if Wall Street is choppy this year, I do think Main Street is going to start to recover and feel a lot better. Stock pickers market, we know that. S&P sector performance year to date, you see real estate, you see materials, you see energy, you see staples, you see industrials, you see healthcare. What don't you see? You don't see tech, you don't see financials, you don't see communication services, all negative. Bull bear indicators a little stretched. Biggest 4-week inflow to global equity funds on record. So they're all chasing in the rearview mirror, which means you probably get a bounce in U.S. equities because everyone's now chasing international because it outperformed last year, which we had been a core of our thesis going into 2025. That will persist in coming years, but we'll have a counter trend, a little bit of weakness. Tech now trades at a lower PE than discretionary industrials and staples. That happened quick. Don't blink, life moves fast. All the trades that people were crowded into last year are now getting taken out to the woodshed. You knew that was coming. You took advantage. Missing the best 10 days of the year can crush returns if you're out. Hedge fund degrossing. Everyone's selling in the hole here because in all the stuff that they were crowded into. This bounce in software is going to be used by institutions who are trapped to get out. So as software rallies over the next couple of months and everyone gets excited again, just know that it will be sold going into the fall. CapEx as a percentage of cash flow from operations headed to 92% by year end. Free cash flow will be negative. Hyperscalers will blink when their stocks are down 30+%, and we will be scooping them up. Credit default swap are rising on tech. They've lent to all these data centers, and now it costs a lot more to insure them, so keep an eye on this. I was at a conference in Las Vegas a couple weeks back. Smart distressed credit guy and I were talking, and he said basically the assumptions are, there are a lot of these CDOs, collateralized debt obligations, Back to the Future. They did it with housing. Now they're doing it with data center loans. And he said if the revenue assumptions are off by 10% on each data center, the B tranche, which is AAA rated, goes to zero. So it's the same old story, Back to the Future once again, everyone crowding in and going to get shellacked. And it'll probably be a few years off because Warsh will lower rates and they'll, extend and pretend. International stocks dominate equity flows this year. Household debt as a percentage of GDP declined materially since 2009. It was up at 100%. It's now at 65. Household balance sheets are looking healthy. financial corporations' debt as a percentage of GDP, also down to 45% from 60%. And dollar value of call volume minus put volume. You can see there's a lot of puts in the market, which implies a couple months of strength ahead of us. Here we go. Equal weight versus S&P 500. We're at the top end of outperformance historically. Median cash shorts taken as a percentage of shares outstanding for the Russell 3000. So shorts are up on the small caps. I think you could see a squeeze there in coming weeks. 3-year-old bulls usually turn 4. That's from FactSet. Trump's weak dollar nearly Trump 2.0 weak dollar nearly matches Trump 1.0. So the implication is that it'll bottom shortly and then start to get a counter trend bounce. I think that could be the case. We'll see. There was a cover on Barron saying the end of the dollar, so we're probably due for a counter trend bounce. Change in doubt between the midterm year low and the high the following year. This is really interesting. Percent change in Dow Jones Industrials between the midterm year low and the high the following year. It averages 46%. So we will raise some cash in coming months, strength, and we will be buying this low to benefit from it. I don't think it will be as pronounced as a normal midterm election year average drawdown of 18.3% because we've had 320 plus corrections in the last 5 years. 6 years, you usually get one every 4.3 years. So they pulled forward about 10 years of 20% corrections. So I think it's going to be more muted. When you think about the tax cuts, deregulation, stimulus, tax refunds, et cetera, I think that's what's going to make it more muted. Main Street's going to be doing better. Fixed mortgage rates on their way back below 6. That's going to be huge for housing. That helps the Generacs of the world, the Stanley Black & Deckers of the world. It's the QXOs of the world, etc. Tax refunds have historically seen a pickup in equity fund inflows. Stocks percentage of S&P 500 stocks outperforming the S&P over the calendar year is at 66%, a high we haven't seen since 2001, 25 years. We love that. A lot of people getting exposure to energy now. We were talking about that last year. Bullish breadth indicators, more broadening. Defensive exposure as growth lags. Inflation. Brazil, China, India are the tariff winners with the IEEPA ruling. UK and Singapore are the losers. Margin debt, market cap adjusted. Okay, so they're showing that margin debt is at a pretty high level. That can continue for some time. So something to keep an eye on. Defensive stocks, relative performance versus the S&P 500, still at 25-year lows. So some of these defensive staples, healthcare, are still bargains, and we are taking advantage. Hyperscaler valuation, next 12 months, price to free cash flow has shot up from 20 times price to free cash flow to 45 times price to free cash flow. So while everyone's focused on next 12 months price to earnings, it's a useless metric. Price to free cash flow, it tells you everything you need to know, and they will have to blink. AI-related CapEx spending was already huge, and now companies are telling us it's going to get even bigger. They will get punished for that this year. After the next few weeks of strength, few months. AI's open planned cash burn is insane, $218 billion a year of cash burn. Here is inventory change of housing, I guess. So you can see where there's positive inventory change like Texas, Florida, etc. You're seeing prices come down already. Someone sent me a Google Trends of house not selling. It's gone parabolic. So the supply, the people who want to sell is now overwhelming the people who want to buy. Places like Napa are down 10% year to date. Florida, parts of Texas, etc. So that is playing out. Affordability is starting to go up. S&P 4-year cycle. Oh, this implies strength into late April as well, weakness into the election, and then a recovery. Emerging markets breaking out at 25-year highs. So probably you get this breakout, continues, back test, and then keep going for many, many years. Emerging markets versus S&P. Again, want to continue to have that exposure in emerging markets. Everyone's going to have to reweight up. China again, because they all took it down in the hole. Now they're going to have to take it back up. New business formation is rapidly expanding. That's interesting to see. Context of AI related components, 70% are mentioning AI. Mag 7 premium is gone. Forward PE spread of the Mag 7 X Tesla minus consumer staples is now to 0. The multiples have contracted to consumer staples levels. There are 44% more home sellers than buyers. I said this was coming to a theater near you. Here's where it goes. And now what's going to start to happen is as you get trades that are below ask, people are going to panic and all try to hit the window at the same time. So if you don't have a house, hang tight. The next 2 years, you will have an opportunity to get a house at lower prices, depending where you live. Maybe not Newport Beach, maybe Newport Beach. I still am 100% convinced I bought the top of the market in Newport Beach, but that was not an investment, and I knew exactly what I was doing. Can't wait 2 years when you got kids who are 11 and 13. So small versus large cap stocks, annualized return relative to 1936. Again, generational, two times every 100-year buy opportunity in small caps. So we've got our exposure there through Papa John's, through Goose, through Comstock Resources, through VF Corp to a lesser. So we got a lot of that, and we're super. And Dentsply Sirona. All right, moving on. Headlines. Alibaba unveils Qwen 3.5 as China's chatbot rate shifts to AI agents. 130 million first-time AI shoppers during Qwen app's Chinese New Year campaign. Still the cheapest AI play in the world. China tech shock threatens the U.S. AI monopoly and is just getting started. Trump will travel to China in late March for high-stakes Xi meet. That should help Baba. UBS sees 20% upside for China stocks on reflationary potential. Opinion follows trend. China holiday spending sends a strong signal on consumer stimulus plans. Bank of America says U.S. stocks draw lowest share of global funds since 2020. Why JP Morgan says international stock story still has legs. China's BYD opens 2026 with blockbuster sales growth in Europe. Cooper Standard, we did the repricing. Tax season presents a boom or bust test for U.S. auto sales. The refunds are going to be big. Sales are going to be good. Forget AI. Tax refunds could give retail stocks a lift. We're counting on that. I think it's also going to help the restaurant sector, which, by the way, I thought it was interesting. Kava had great earnings. So now it's becoming selective which restaurants are doing well, which restaurants weren't. And what else did really well? Domino's did exceptionally well. So we'll see if that passes through. Diageo shares sink on cuts to guidance. Dividend is new boss. Set sights on turnaround. This is the guy who turned around Tesco. He's coming in with a hammer. And what do they all do in their first quarter? They kitchen sink the quarter, take all the cuts, take all the write downs, set expectations low so they can beat for the next 8 quarters. So this guy is no different. We took advantage of the weakness, and we're perfectly fine with that. Dave Lewis plans executive overhaul at Fat and Happy Diageo. We love it. Estee Lauder eyes M&A opportunities to help turn around, CEO says. GXO sees demand tailwinds across North America as automation drive intensifies. Generac signs agreement to acquire Enercon accelerating growth in data center and switchgear markets. More than 500,000 customers have lost power on the East Coast. That should also help Generac. U.S. mortgage rates reached the lowest level since 2022. Spurs refinancing. It's at 6.09%. We're going to hit 5.99. Housing starts jumped to highest level in 5 months, showing momentum going into the new year. Pfizer nabs China obesity drug rights in $495 million deal. Boeing bags orders for almost 100 jets from Vietnamese carriers. And Hormel posts higher profit sales amid turnaround they're executing. Papa John's International closing hundreds of pizza shops, all the 300 non-profitable. It's the Advanced Auto Parts playbook. Cut the losers, invest in the winners. They'll be back on track with the Wendy's way. The guy who turned around Wendy's is turning them around. Take a half a step back before you take 5 steps forward. Etsy sells Depop, a secondhand clothing app popular with Gen Z, to eBay. They got $1.2 billion in cash. They actually sold that at a profit. So now they can use that to invest in the core platform. Venezuela's oil output can climb 30 to 40% this year, U.S. says. We like that for the oil servicers, a.k.a. National Oil Well Varco. U.S. economy can grow at least 3.5% in 2026, Besson tells Fox News. That's going to help Main Street more than Wall Street in the short term. Can AI productivity boom clear a path for more rate cuts? Trump's Fed pick thinks so. So he's going to shrink the balance sheet to sop up liquidity, and then he's going to cut rates to offset it and spur the housing and investment and debt refinance, which will all be positives. Trump proposed a new retirement plan with up to $1,000 match, how it might work. We talked about that on Fox. AI doom overstated. Citadel presents historical precedent, suggests slow adoption, economic resilience. You should pull up that Citadel report. It is called the 2026 Global Intelligence Crisis. There was that ridiculous report out over the weekend that everyone was circulating, written by a guy who had a background as an emergency medical technician and a weed dispenser in the state of Connecticut. And everyone took it like it was gospel. And then they realized, wait a second. Okay, so we've got the Bank of America Fund Manager Survey. I want to get through quickly some of the key points here. Number one, for the first time in 10 months, the net majority of fund managers believe small caps will outperform large caps. Opinion follows trend. Number two, fund managers' combined allocation to equities and commodities sits at a net 76% overweight, the highest since January 2022. So that can persist for a few months, but we kind of get where we are. Three, fund managers now the most overweight emerging market equities since February 2021 with a net 49% overweight exposure. Again, opinion follows trend, so keep an eye on that for a counter-trend pullback. A record high share of fund manager surveys now believe companies are over-investing, with a net 35% saying CapEx is too high versus 26% last month. The question is, which company will blink first and when will they blink? My guess is a few months from now, and then they will all follow suit, and then everyone will get more pessimistic on the AI trade, and it will be the time in the fifth inning to buy it again for the next 5 years of run. And sentiment measured by cash levels, equity allocations, and global growth expectations rose to 8.2 from 8.1, the most bullish reading since June of 2021. We are cognizant of these things. Here's Advanced Auto Parts, building this base to recover. Advance is advancing. 2025 marked a clear step forward in the AA Advanced Auto Parts turnaround. As CEO Shane O'Kelly's expertise has proven to be exactly what this long-struggling auto parts retailer needed. The playbook is centered on replicating the highly successful hub-and-spoke model that industry peers like O'Reilly and AutoZone have used for years to frankly eat advanced auto parts lunch. AAP has been the industry's red-headed stepchild for too long, running on an inefficient supply chain that failed at the most basic objective of having the right part in the right place at the right time. O'Kelly, who previously led major chain overhauls as CEO of $8 billion HD Supply and PetroChoice, wasted no time rolling up his sleeves and ripping off the Band-Aid. Distribution centers have been consolidated from an inefficient 38 facilities, all with varying sizes and systems, to just 16 by the end of 2025. More importantly, those DCs are no longer being asked to do everything. They are now complemented by a growing network of market hubs. These hubs carry 75,000 to 80,000 SKUs and enable same-day delivery across 60 to 90 stores, a strategy already driving 100 basis points of average comp lift. Advance opened 14 new hubs in 2025, bringing the total to 33 and keeping the company on track for 60 by 2027. At the same time, AAP completed its store footprint rationalizations, closing more than 700 underperforming and unprofitable stores to focus on the strongest markets. Auto parts retailer is a game won through concentration and density, and Advance now holds a number 1 or number 2 share position in more than 75% of the markets it serves. The remaining 4,305 stores are receiving long overdue facelifts, from parking lots to signage to racking, so they can actually look open for business. This is blocking and tackling at its finest. No reinventing the wheel or curing cancer, just getting back to the basics of selling auto parts. While it's a multi-year endeavor and intensive turnaround effort, the fruits of this heavy lifting are starting to show up in the numbers. Advance delivered plus 0.8% comp growth in 2025, inflecting positive after 3 consecutive years of declines. The most important metric of the turnaround, adjusted operating margins, expanded 213 basis points to 2.5%, marking more than 500 basis points of improvement since O'Kelly and his team took the reins. For context, margins troughed at just 0.4% in 2024, the weakest level in more than 20 years, and a far cry from Advance's historical 9 to 11% range and the 19% to 20% posted by peers AutoZone and O'Reilly. Today's results are only just coming off the mat from these depressed levels, with plenty of low-hanging fruit to help narrow the massive gap. Management's midpoint guidance for 2026 implies another 165 basis points of margin expansion to 4.15%, with at least 100 basis points on deck for 2027. While that likely pushes the original 7% target to 2028, management remains confident in the framework, and it's simply a matter of pacing. This delay was largely telegraphed by consensus heading into the report, and even despite clear signs of progress, estimates are still taking the under, sitting at just 4.9% for fiscal year 27 and 5.2% for fiscal year 28. With the underlying margin framework in place and showing signs of working, we are more than happy to side with a proven operator like O'Kelly on this one. At the end of the day, the foundation has been laid and the heavy lifting is largely complete. 26 comes down to executing the playbook, cleaning up merchandising, unlocking supply chain productivity, and improving store level operations. Again, this is simply blocking and tackling done right. It also helps to operate in an industry that is 90% break, fix, and non-discretionary. If your car breaks down, you have no choice but to get it fixed. On top of that, there are structural demand drivers that aren't going anywhere and put the wind at their backs. Record high average vehicle age of 14.5 years per vehicle. Record high vehicle miles traveled exceeding 3.3 trillion. Our confidence in the AAP turnaround continues to work higher. It may take some time, but when operating leverage meets a proven operator and structural demand drivers, good things tend to happen. So we've highlighted all the key things. By the way, while you're at hedgefundtips.com reading this article, you can find it under popular posts or in categories under commentary. Be sure to click on terms. This is all opinion, not advice. And that's that. Moving on. So we've gone through all the important things in the call and the deck. And you can read the 10 key points posted in the article on the website, as well as read the key points from the earnings call transcript. Moving on now to Etsy. Top 10 points in the Etsy call, which we've also highlighted all the key points in the deck and in the earnings call transcript. Etsy delivered Q4 revenue of $881.6 million, up 6% year on year, excluding Reverb, and marking a new quarterly record. Marketplace revenue increased 0.8% to $612.4 million, while higher margin seller services grew 9.9% to $269 million. For the full year, revenue reached $2.88 billion, plus 4.9% year on year, excluding Reverb. 2. Consolidated gross merchandise sales increased 2.4% to $3.59 billion, in line with consensus and prior guidance of $3.5 to $3.65 driven by core Etsy GMS rising 0.1% to $3.29 billion. First positive comp since Q3 2023 and nearly 900 basis points of improvement since Q1 2025. US GMS on the Etsy marketplace also grew for the first time in 4 years, plus 0.3% for fiscal year 2025. Total gross merchandise sales reached $11.92 billion, minus 1.1% year-on-year ex reverb, and the core Etsy GMS of $10.46 billion, minus 3.9% year-on-year versus negative 6.6% in fiscal year 2024. Key customer metrics continue to stabilize, including trailing 12-month gross merchandise sales per active buyer of $121. Third straight quarter of stable or improving trends, 17.2 million gross buyer additions, first growth in 2+ years, and 5.6 million active sellers, negative 1.5% year-on-year with sequential growth and improved retention. 3, prior to earnings, Etsy announced the sale of Depop to eBay for $1.2 billion in cash. With the transaction expected to close in Q2 of 26, Depop grew rapidly in fiscal year 25, generating $1.1 billion of gross merchandise sales, up 36%, but it was significant headwind to profitability, representing a 350 basis points drag on adjusted EBITDA margins, while its structurally lower take rate reduced consolidated take rate by 80 basis points in 2025. Etsy acquired Depop in 2021 for 1.62, 23 times sales. What a bunch of morons. Okay, so they're selling it at a loss. And the 1.05 impairment taken in 2022 confirmed the overpayment. What a bunch of schmucks. Well, at least we have a new CEO. The $1.2 billion sale price represents a $420 million haircut to the original purchase price, yet still equates to 6.4 times sales and more than 25% of Etsy's current market cap for a business that accounted for just 9% of 2025 gross merchandise sales, with proceeds targeted towards buybacks and reinvestment in the core marketplace. 4, the Etsy mobile app continues to outperform, with app GMS accelerating 6.6% versus 5% in Q3. Downloads increased 4% year-on-year, and app GMS now represents 46% of total GMS, stable sequentially and up 500 basis points over the past 2 years. App users generate 40% higher lifetime value than non-app users, driven by more frequent visits, deeper engagement, and higher conversion rates. App users also tend to skew much younger, making the app a key channel for engaging this important demographic. 5, Etsy's marketing spend in Q4 increased 7.3% year-on-year to 34% of revenue, plus 120 basis points, with the step up largely driven by accelerated investment at Depop. Management continues to pivot away from linear TV toward digital channels such as YouTube and TikTok, where returns have been strong, and targeting younger consumers has proven more effective. Etsy doubled its TikTok spend during the quarter while maintaining ROI in line with prior levels. The company is also leaning further into personalization across owned channels, with personalized push notifications and emails rising from less than 25% to more than 75% of total sends, driving email and push clicks up more than 25% year-on-year. 6, in addition to previously announced integration with OpenAI's ChatGPT instant checkout, Etsy has launched agentic shopping partnerships with Google and Microsoft, enabling signed in the US users to purchase select Etsy items directly within AI-powered experiences, including Gemini and Copilot. Agentic remains a very small portion of traffic and GMS, less than 1%, but traffic grew 15x year-on-year in Q4. Early signals are encouraging, with higher average order value, strong engagement with Etsy listings, and a meaningful share of purchases coming from lapsed buyers via ChatGPT, suggesting agentic could become a powerful lever for retention and reactivating Etsy's pool of 100 million lapsed buyers. 7, Etsy generated $308 million of free cash flow in Q4, bringing free cash flow for the year to $639 million, a 12% free cash flow yield, with adjusted EBITDA to free cash flow conversion of 87%. Management returned well over 100% of free cash flow to shareholders, repurchasing $777 million of stock during the year and reducing the share count by 14.4 million shares, a 19% reduction over the past 2 years. Remaining repurchase authorization stands at $973 million, enough to buy nearly 20% of the company, supported by $1.4 billion of cash on the balance sheet before factoring in the $1.2 billion of expected Depop proceeds. 8, adjusted EBITDA margins came in at 25.2%, minus 420 basis points year-on-year, ahead of prior guidance of 24%, bringing fiscal year 25 margins to 25.5%, minus 230 bips. Year-on-year, the contraction was largely driven by stepped-up investment in Depop, which will now roll off following the sale. Ex-Depop, the core Etsy marketplace delivered its highest adjusted EBITDA margin of 2025 at nearly 30%. 9. Consolidated take rate expanded 170 basis points in Q4 to 24.5, in line with prior guidance, bringing fiscal year 2025 take rate to 24.2 plus 190 basis points. Expansion was primarily driven by continued strength in consolidated on-site ads, with management expecting further take rate growth in 2026 to 25.5%, up 130 basis points. 10, management guided Q1 26 gross merchandise sales to 2.38 to 2.43, plus 2% to plus 2 to plus 4% year on year. For the full year, management expects a return to positive GMS growth with positive comps in each quarter, and Q1 likely the strongest. Adjusted EBITDA margins are guided to 28% to 30% in Q1 for fiscal year 26, implying 350 basis points of expansion at the midpoint. How you doing? We like to hear that. Let's go down to market sentiment is kind of neutral at 46. Active investment managers, 80% exposure. I think this is going to get popped up here. I think this is going to break out to the upside over the next couple of months. Okay, we're not open for the smaller accounts. We'll be opening up for the smaller accounts sometime in April. Larger accounts, the normal 5 to 10 million plus, can come in any time. Opinion, not advice, not a solicitation. Healthcare, top 30 weights earnings estimate revisions in the last 60 days were revised down by 32 basis points. Financials, top 30 weights earnings revisions revised up 1.73% for this year and up 1.59% for next year. Let's get on to the Ask Me Anything questions from our amazing audience. First question comes from John S. Thoughts on Stone, STNE. This is Brazil. This is consumer, though, and the reason we tend to avoid the consumer. Okay, so someone was telling me that I could get rid of, what is this? Ooh. Oh. Ooh, I like that. Thank you, whoever told me that. Someone sent that in and said, you can get rid of that so you can actually see stuff while you're talking. This one looks like it wants to start to turn positive. The thing about it is the consumer portfolios, consumer debt portfolios, I think this is going to work, but there's no way to have any transparency. So you're kind of just making a levered bet on Brazil, which is probably the right bet to make. But financial and software solutions, mobile payment, credit solutions. Let's see what the balance sheet looks like here. $1 billion of cash, $6 billion of debt. $7 billion of receivables. Cash flow. Let's see if it's doing anything quarterly because it's not last 12 months. Still negative. Let's see what the share count looks like. Yeah, this is a gamble, but I think it's going to work. We won't be involved, but I understand why you're interested in, John. It's a pass for us, but I think it's going to work if you take it as a trade, but you size it accordingly because there's a lot that you can't know, and that's why we would never be in it personally. But from a trade, I think it's going to work. This was from Agathan Rex, who told me how to get rid of that stuff. So thanks for that. All right, let me see if there's anything in here. Goodyear. Yeah, we looked at this a million times. I think it's going to work. I think it's just a bad business long term because they got destroyed by the Korean tire makers and the Japanese tire makers. It's just a way to, there's no sign of positive free cash flow imminently. It probably works as a trade, but we're not going to be involved in that. So we're going to skip that one. Linda Williams, AVTR. Wow, this thing's gotten beat down. What did they do? So the revenue's peaked. Free cash flow is not turning yet. Description. Mission critical products and services to biopharma, healthcare, applied materials industry, purity chemicals and reagents, lab product supplies, silicone materials. Yeah, this is kind of in the sweet spot. That's their issue. We've got a decent amount of debt. Let's see. $365 of cash, $1 billion of receivables. Long-term debt is $4 billion. $3.9 billion. 350 is current. So that's why you got a stock that's down a lot. And share count's pretty steady. It's been a low compounder for a long time. Where is the free cash? $500 million. Let's try the last 12 months. 650 million. Yeah, this one's tough. I think it certainly warrants a lot more research. You might have something here, Linda. So you just want to see when all that debt matures. That's going to be a key. You know, that's the key with Papa John's. The debt doesn't mature for another 4 years. So I like your find. I think it warrants more research. So I'll write that one down. Little levered for us. Alejandro Bustamante, Pool. Yeah, I've been looking at this one too. Yeah, I kind of like this one. Let me just see if there was anything that was keeping me back from really liking it. Yeah, no real turnaround in revenues yet. So is it back to pre-COVID? Yeah, just about back to pre-COVID. Free cash flow positive. Gross margins are still down. They're worse than pre-COVID. Multiple's a little high. This is a long-term compounder, though. I kind of like this one. Let me just see here. I just like to see some ability for them to accelerate revenues. Bringing in the share count. Stock-based comp is a little bit hefty there, but I'm going to say, Alejandro, I like it. I think you're going to do fine with this over the long term. I think it's okay. Good work. basic thesis is everyone put in a pool during COVID, and now they have to service them. You can't really fill in a pool to save $50 on chemicals. Worldline, WLN. It's an $84 stock. Now it's or euro. Now it's a $4 euro stock. That's incredible. What do these guys do? Transactional services for financial institutions. Yeah, so it's payments, which are all getting killed. The only payments company I really like here is PayPal, because in Europe, Stripe kind of owns it. I mean, you could get a pop, but I think same with Stone. It's like these things are beaten down, but I don't think this is a big enough business where they're going to be able to build an ad business around it. And, they don't have a stable coin, and share count is going up. I mean, it's cheap enough. You probably don't get hurt, but I think I'd probably avoid it. It's kind of like a lot of these software stocks. They're going to bounce huge, but all right. David H. Thanks for the life-changing opinions, not advice. This is David H. says, Tom, thanks for the life-changing opinions, not advice. I'm up 250% over the last year and a half and pacing well to be a client in the next couple of years. Lost count on how many people I've shared your channel with. Well, thank you very much and congratulations. He said you have a BS filter. Like, how do you evaluate management? I look at their say-do history. So what have they done in their previous companies? What have they done recently? And how, you want to get a business that's so good that a ham sandwich could run it, because one day a ham sandwich will run it. That's been always Buffett's thing. So it's like, first, just look at their track record like anyone else. And number two, make sure the business is good enough to withstand an idiot, because if he's that bad, they'll replace him or her, and you'll be fine. But that's a good question, and the only thing you can do is what have they said and what have they done. Opinion on Accenture, 3%, and some of it's instinct too. 3% dividend yield, record EBIT, record free cash flow. Yeah, this is a consulting business. Again, they're not going to go out of business, but a lot of the stuff that they were paid to do and can be done now by AI. So I don't know where the floor is on this, because these were all overvalued, and they're still generating cash. I mean, some of these you're going to want to take a punt on, but we're just not going to be involved because it's guessing and trading. It's not. All right, SUUIF. We would have never owned that type of business before the AI, and we're not going to own it now. What are you giving me here? A penny stock? SUUIF. Superior Plus Corp. Revenues are accelerating. Free cash flow is accelerating. Margins are good. Multiples are low. What do they do? Distributes propane, compressed natural gas, renewable energy. So this is the issue. You got some leverage there. $51 of cash, 300, and how much debt. 1.7. I'd probably be a pass on this, my friend. Free cash flow is pretty good. Revenues are flat. Share count's going up. I would avoid something like this, to be honest with you. I mean, I understand the temptation here if you buy it at 6 cents and it goes back to $1. But I think you're gambling more than anything with that kind of balance sheet. Guy Ryan, Badger Meter. So here's a stock that's up 25x. It's pulled back a little bit. He wants to buy it. I don't think there's enough margin of safety, and it's not going to, even if it does everything you think, the idea of getting a double in 3 years is very low. So it's not going to meet our IRR requirements. Free cash flow is pretty good, but what you're paying for it is pretty high. It just hasn't pulled back enough. I would think this would become, let's look at it again if it gets down to $100. But right now it's still a little bit too rich. Alex Winkler. General time horizon for the options, usually 2+ years. We do, if we're doing puts, those are much shorter term, usually a few months if we think the market's overvalued and we're hedging out. And we try to do spreads where we can. John Liu, CPS announced, blah, blah, blah. Why is it down today? Again, I don't care why it's down in a day, but people thought they'd get a better deal. Maybe they'd get 200 basis points of savings. They got 112 basis points. Key is they have got nothing to worry about for a handful of years, and while the cycle comes back, that's all that matters. Joel Gravina. Oh, he wants us to manage money for them. Manny B, PagerDuty, SAS. That's probably a pass for me. Any SAS is a pass. Ooh, look at that. Wow. Dumpster diving today. All right, what do we got here? Yeah, look, everything looks great except they have no defensible moat, or a moat that's very hard to discern how long it lasts. Digital operations platform collects data and data signals from a software-enabled system or device. Leverage machine learning, correlate process, predict opportunities and incidents. Real-time view against This thing's right in the middle of the storm. The issue with all these software stocks is not that their financials are not still good, because in most cases they are. It's assigning a terminal value to them based on what the future looks like a few years down the road. I mean, look, Manny, I can't with a straight face tell you not to buy this thing. We would never do it because we just avoid software. We don't understand the moat. But if you have an expertise in the industry and you say this can't be disintermediated, it's cheap as hell here, but they're kind of growing the share count a little bit, and their stock comp is a little bit insane, but it's not for us. But I understand the interest, and you're not wrong, but I can't discern the moat. Turnaround Town, been a fan for a while. Dexcom. Brock wants to know about DXCM. Medical device company, glucose monitoring system, diabetes. Yeah, the whole diabetes group has been hit since GLP-1s. This one's probably going to be okay. The problem that I'm finding, I think it's going to be very hard to get a double plus within a few years. So for us, it does not hit our threshold of what we'd be interested in. $2 billion of cash. Yeah, it's pretty healthy balance sheet. Share count's okay. Cash flow's okay. Yeah, I think this one's probably okay here, but it's not the highest and best use of capital. Thanks for sending it in. Brock. Yeah, got that one, Brock. Lachlan. Reddit. You know, some of these. So it was a 10 bagger. Now it's pulled back a little bit. It's very hard to predict how long these fads last. Pinterest got smashed. Their numbers look great. Reddit's numbers look fine. Let me just take a look here. Yeah, this is where I have a problem, though. The huge increase in share count from 60 million to 145 to 186. Guess where it's all going? To management. That's just a disease you can't cure. They're pigs. They're stealing from their owners to line their own pockets. A lot of cash, 2.4 billion in cash, probably no debt. Let's take a look at 22 times next year's earnings, enterprise value to EBITDA 19 times, $28 billion market cap for this thing. Enterprise value 25 billion off of 3 billion of sales. I mean, you're making a bet that this platform is going to stay super popular. If you have some edge there, maybe you can make the bet with these financials, but I don't think it's come down enough. I'd revisit this thing back after it round trips and no one wants it, like after it does a Peloton. It may never do that, but there's not enough margin of safety relative to the risk. Cody, ooh, this thing has been a value trap forever. I don't quite understand why this can't get off the mat. I mean, I think the key thing with Cody is going to be, I definitely think it works for a bounce here for sure. But what's the catalyst for change? Bringing the debt down. Share count keeps going up. Free cash flow is okay. pretty staggering amount of stock-based comp. Yeah, I would just want to know the catalyst for change, but I do think this is going to work for a bounce for sure. And isn't this a Brazilian company? I mean, they have brands all over, but I think it's a Brazilian company. No, it's based in New York. I don't know why I thought it was Brazilian. Oh, JAB Beauty BV. Overgirl. Yeah. Yeah, just get comfortable with the turnaround plan, Bruce, but I think that's probably going to bounce. All right. Jennifer G. Tidewater. Yeah, so this is up 25x off the lows. I continue to like National Oil Well Varco better than this. We get it every week. So they've already inflected. That's known. Let's take a look at the financials here. $428 million of cash, $649 million of long-term debt. That looks okay. Free cash flow turning up. Income statement turned up. Share count, it's okay. It's going up a little bit, up 20%. A lot of stock-based comp. I think it's okay. I like National Oil Well Varco better. I just like things when they're down, not when they're up. Raul Shah. Oh, okay. I met him doing TV. Nick Ruggs. Oh, cool. Nick says, wanted to thank you for everything you share on the podcast. The discipline and perspective you bring have genuinely helped me level up how I think about investing. I also ordered a hoodie and a t-shirt and love them. Great quality. Quick question. What are your thoughts on Novard, NVO? One day I'll be in a position to become a client. That is probably true. Just stick with it. Novo Nordisk. Yeah, this thing is starting to get pretty darn interesting. Problem is, they're cutting costs because the better drug came out from Lilly. Free cash flow is turning down. But yeah, their diabetes and rare disease is still strong. I think you're getting close, my friend, is the answer, but there's just going to be such a weight on it for a little while because they don't have the hot new obesity drug. So I think what you have to do is get on the calls and understand how they're going to continue to compete other than cutting prices. But I do think we're close. billion of free cash flow. $180. So 20 times free cash flow, enterprise value to free cash flow, dividend yield. I don't think you're going to get hurt here. I think it's going to take a little while to build a base. If you can get it closer to 30, try to do that, because it's very hated, and also get an understanding of like what do the metrics look like if the obesity business gets cut in half again from here. Is the rest of the business growing and that type of thing? But I think you're pretty close for what I can do on a 2-minute look. Dario P, I've got my eye on it. I'll put it that way. NVO. Thanks for all your work, providing value. Blah, blah, blah. I saw this class action lawsuit against PayPal. Was interested in your thoughts on. These are just a bunch of ambulance chasers. Every time a stock goes down, they file a lawsuit and the company has to pay them off. It's just a shitty way to live, but there are people who do it. Adam Cizzoni is asking about ETHM, Andrew's Ethereum trust. Look, it's just going to be a leverage play on Ethereum. They're best at operating and staking and all that stuff. I think, this is not my world. I invest because he's a friend, but if anyone's going to figure it out and make a ton of money with him, that's the jockey I want to bet on. And I do think there is merit to the idea that as he explained it to me, the internet was a platform and all these multi-billion-dollar apps were built on top of it. Google, Amazon, et cetera, et cetera. And Ethereum is going to be the next platform. The banks are using it. All these other multi-billion-dollar companies, public companies, are going to be built on top of Ethereum. So owning part of that real estate is pretty valuable. You just got to take a long view. I invested money I was willing to see go to zero. I think it's going to wind up making a lot of money in spite of me, but I have zero expectations on it other than betting on the jockey, which if that group is going to win, he's going to be the best jockey to bet on. And I think it is going to win, and it's just going to take longer than everyone thinks. So I'll leave that there. Okay, that's that. Gerald, Energizer Holdings. Yeah, this is just this shouldn't even be a public company. This is a value trap. Revenue's going nowhere. Margins, free cash flow. I just don't think you're going to get any, you're not going to get an IRR above the market. Is it cheap? What are you doing? You're probably buying this thing for a dividend. Let's see. Where's the dividend yield? 5%. Okay, so it's better than a bond, and if that's why you're buying it, let's just see if it's got a good enough balance sheet to be sure about that yield. $214 of cash, $214 million of cash, $3.2 million in long-term debt. If you're just buying it for the dividend, I wouldn't buy it. I don't know what the growth story is here. I think it looks like a value trap. It's not a highest and best use. I understand why you're interested, but I think you just take a pass. Wilford Frost asks about Gentex. GNTX. Again, I don't think you're going to get a multi-bagger here, but it's probably a decent business at a decent price. Margins have been compressed for a while. Digital vision, connected car, dimmable glasses, fire protection, medical devices, and other consumer electronics. Doing rear view mirrors, so it's an auto part play. I think this is kind of dead money. Let's see here. I don't think you're going to get hurt. I just don't think you're going to get an IRR above 30. So you're probably not going to lose. You're going to win a little, but Comstock Resources buyer down here, question mark, natural gas selling off. I don't know. We bought it at $8 and $9. What's it now? $20? $18.50. No, we're not buying more. We're just holding what we have until it hits 50, 60, 70, and then we'll get out. Let's see. Tenant Co, TNC. Thought I had share count here. What do these guys do? Floor cleaning equipment. Cleaning equipment for industrial, commercial use, detergent free. For robotic cleaning equipment. Direct sales. Yeah, I just, again, I just don't think you're going to get a high enough return in a short enough period of time with this. I think it's probably going to work. Let's see the cash. It's the debt. That's fine. That's fine. It's fine. It's fine. It's just you're not, it's not going to find a place in an 8 to 12 stock portfolio because the expected returns are not high enough. What do you think about Uber? No, that could get disintermediated pretty quickly. Zach Meyer. Are you getting to the closer to the point of taking profits on National Oil? Well, Varco, as it's up 70% from when you mentioned it. No, absolutely nowhere close. Jason Zen. Next, Scott Russell. CAG, congrats to your team, the Devils, and Jack Hughes. Thank you very much. Congratulations to all of us. Yeah, Conagra we cover every week. We've been saying yes since it was down here. You're fine with that one. Cameron, oh, that's an investor. Jeff. Okay, Almas. The reason, no, you want to own the stock for Dentsply Sirona because you're not going to get the timing right, number one, and the implied volatility on the options is too high, and there's not enough liquidity anyway. Eric Haney, Palo Alto Networks, PANW. Not yet. Too early. York Bourgeois. Yeah, we're looking at it, but nothing yet. He's asking about NVO. OERL. OERL. No. Got to show me some sign of recovery in revenues. No. Next. Thanks for the article, Paul Falcone, Kenny T. Yeah, NVO we covered. Thanks, Don. Glad you're having those results. Okay, Brendan. Brendan's asking about insider buying in PayPal. We'll see. Duolingo, we've covered this one, Philippe. It's a software thing. Duolingo's great. My kids have used it, but Duolingo. Numbers look great. We've covered this like every week. It's like Chegg was. People are going to be scared this thing gets disintermediated. I'll bet the financials look good. It's going to take a long time to build a base if they actually exist. But, financials look great. But again, you can't touch that right now. Panagiotis, FTNT, another software one. These are all going to rally short term. No, it's not down enough. And get sold off later in the year. Okay. That's that. Here, Brian McLean asks, I love the podcast. Been telling those I know about it since 2022. Thank you so much. Robert Half and other talent acquisition companies. Yeah, not for me. I get it. I generally avoid these companies. But maybe at these levels, you could take a punt. We won't, but you might. I mean, there's no sign of recovery in revenues here. Free cash flow. Stock prices come down with the performance of the business. I mean, it does look like it wants to bounce. It's not for us, but I do see it working from a trading perspective, but we don't do that here. Chris Williamson. I have some debt in Brazilian reals, blah, blah, blah. So he's asking a currency. The dollar is going to weaken more over the next 2 years, if that's your question. Thoughts on Nutrien, NTR? You're a little late. It's up double off the bottom. It probably goes higher, though. It's another chemical play. Yeah, it's not for me. This is from Brandon. Adobe, another software darling. Numbers look great. I wouldn't touch it. It's going to bounce here. And I'm sure the financials look fantastic. Better than ever. Yeah, can't get involved with software. And that has nothing to do with AI. We've just generally avoided software because Buffett never did it because he could never get comfort around the moat. We're kind of in the same boat there. That's an investor, and we're done. We'll be back next week, same time, same place. In the meantime, make it a great one. Thanks for tuning in. Bye for now. Pause your video player to review our terms and disclaimer. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Great Hill Capital LLC or PPI is not under any obligation to update or keep current the information contained herein. Great Hill Capital LLC or PPI and its respective officers and associates or clients may have an interest in the securities, derivatives, or entities referred to in this material. Great Hill Capital LLC or PPI accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.